Some companies should have died years ago, yet somehow they still dominate your daily life. They lose billions, miss targets repeatedly, and still receive loans, subsidies, and endless second chances. Meanwhile, small businesses disappear quietly after one bad quarter or unexpected economic slowdown hits hard. That difference reveals something uncomfortable about modern capitalism most people never fully notice today. Failure isn't always punished anymore, especially when collapse threatens larger financial systems and political stability. In fact, some companies become so connected that governments fear letting them actually fail completely. And when that happens, the costs rarely disappear. They simply move somewhere less visible, usually toward taxpayers, workers, consumers, or future generations inheriting quietly accumulated financial burdens later. To understand this system, we need to start with how businesses normally survive competition. In theory, capitalism rewards efficient companies and eliminates weak ones through market pressure naturally. Bad products fail, reckless decisions collapse, and stronger competitors replace outdated business models eventually. That destruction sounds brutal, but historically it helped economies adapt, innovate, and improve productivity over time. But modern economies became deeply interconnected, and failures started carrying much larger systemic consequences everywhere. Banks lend money across industries, pension funds hold corporate bonds, governments rely on major employers. Suddenly, one collapsing company can trigger layoffs, defaults, panic, and political outrage simultaneously nationwide. So instead of allowing collapse, leaders increasingly choose rescue operations disguised as temporary stabilization measures. The language always sounds careful, responsible, and reassuring during these extraordinary economic interventions publicly. Protect jobs, preserve confidence, maintain liquidity, prevent contagion, restore stability before markets panic further. Notice something interesting though. Ordinary people rarely receive that same emergency protection during crises. Miss rent payments repeatedly, and nobody declares your household systemically important to national stability immediately. But giant corporations operate under different rules once their failure threatens broader financial structures globally. This creates a strange incentive economists call moral hazard, though reality feels far less academic. If companies expect rescue during disasters, risk suddenly becomes less dangerous for executives pursuing growth. Profits remain private during successful years, while losses partially shift onto society during collapses later. It's capitalism during expansion, but something strangely different whenever consequences finally arrive afterward publicly. The pattern became impossible ignoring after the financial crisis exploded across global markets during 2008. Banks packaged risky mortgages, earned enormous profits, then watched the entire structure suddenly unravel worldwide. When panic spread, governments intervened massively because failure threatened freezing the global financial system completely. Trillions appeared almost overnight through emergency lending programs, bailouts, guarantees, and central bank interventions everywhere. The speed was remarkable, especially compared against ordinary political debates about healthcare or affordable housing. Suddenly, impossible money existed. Once powerful institutions faced existential danger threatening broader economic confidence everywhere. And that revealed something critical about modern economies most citizens rarely discuss openly enough today. Large corporations aren't merely businesses anymore. They function like infrastructure, supporting entire financial ecosystems globally. Airlines connect commerce, banks distribute credit, technology firms manage communication, logistics, and consumer activity constantly. When infrastructure fails unexpectedly, governments usually intervene because consequences extend beyond shareholders and executives alone. That logic sounds reasonable initially, until you realize incentives begin changing underneath the surface quietly. Companies grow aggressively, knowing size itself increases chances receiving future political and financial protection later. Bigger becomes safer, not necessarily smarter, more productive, or better managed over long periods economically. This creates corporate giants difficult replacing, even when performance declines or innovation slows dramatically over decades. Investors notice this too, which changes how financial markets price risk across major industries globally. If markets believe governments prevent collapse eventually, borrowing becomes easier for struggling corporate giants indefinitely, daily. Cheap debt delays consequences, allowing weak companies surviving far longer than competitive markets normally permit developing. Economists sometimes call these businesses zombie companies, technically alive, but economically weak underneath everything operationally daily. They earn enough surviving temporarily, but not enough growing, innovating, or reducing accumulated debt meaningfully. Yet they continue operating because lenders fear losses more than long-term economic stagnation developing gradually. So resources remain trapped inside inefficient companies instead of moving towards stronger, productive businesses elsewhere. That slows innovation, reduces competition, and quietly weakens economic dynamism across entire sectors over time, across time. Consumers notice symptoms eventually through rising prices, declining quality, fewer choices, and stagnant services everywhere. Ironically, the system protecting stability can slowly create deeper instability beneath everyday economic life itself. And the costs rarely appear clearly on one visible government invoice sent directly afterward. Instead, they spread invisibly through inflation, taxes, public debt, slower growth, and reduced competition globally. You pay gradually, indirectly, and quietly enough that outrage rarely concentrates towards specific decisions politically, anyway. That invisibility matters because systems survive longer when consequences feel distant and difficult tracing precisely now. Layer politics into this already complicated relationship between corporations, governments, and financial markets globally. Large companies employ thousands, fund campaigns, influence regulations, and shape local economic realities constantly nationwide. Politicians understand collapse means angry voters, unemployment spikes, and terrifying headlines dominating news cycles everywhere. Saving companies becomes politically safer than explaining why painful failure might benefit economies eventually, long-term, long. Because voters experience layoffs immediately, but rarely notice productivity improvements developing years afterward, economically, nationwide. So leaders often choose short-term stability, even when long-term distortions continue quietly growing underneath markets. And financial markets reward short-term certainty far more enthusiastically than uncertain structural reforms politically, anyway. This feedback loop keeps expanding, making future rescues feel increasingly inevitable during every major downturn. Each intervention changes expectations, and expectations slowly reshape how institutions behave during crises afterward globally anymore. Companies borrow more aggressively, investors chase riskier returns, and governments prepare larger rescue mechanisms continuously, gradually. The safety net grows wider, while the underlying system becomes increasingly dependent on continued intervention indefinitely. At some point, economies stop merely supporting markets and start managing them continuously behind scenes. And once markets expect management, true failure becomes politically and financially harder, allowing any more afterward, gradually. This creates another uncomfortable question nobody particularly enjoys discussing during optimistic economic headlines publicly anymore, gradually. Are these companies surviving because they're valuable, or because collapse became politically unacceptable altogether now, gradually? Those aren't necessarily the same thing, though modern systems increasingly blur that distinction economically, everywhere, gradually.
especially when retirement funds, employment levels, and national confidence depend heavily upon corporate survival continuously, gradually.
Now consider what happens when interest rates stay unusually low for extended periods globally afterward. Cheap borrowing allows struggling businesses refinancing debt repeatedly instead of restructuring painful operations completely internally. Weak companies survive longer, but productivity growth across entire economies often begins slowing noticeably afterward. Japan experienced versions of this pattern during decades following its massive asset bubble collapse historically. Europe later faced similar concerns after prolonged financial weakness and extremely accommodative monetary policies emerged. Even healthy businesses suffer eventually because distorted competition changes pricing, hiring, and investment incentives everywhere nationally. Imagine running efficiently while competitors survive mainly through endless refinancing and implicit government protections indefinitely. The market stops rewarding strength clearly because weakness no longer guarantees meaningful consequences anymore economically. That uncertainty changes behavior throughout the entire system, from startups to multinational corporations operating globally. And ordinary consumers usually notice only fragments without seeing the larger structural mechanics underneath everything. Higher airline prices, fewer local banks, slower innovation, declining customer service across essential industries nationwide. Small frustrations connected invisibly through incentives shaping modern corporate survival behind economic corporate headlines constantly today. Meanwhile, executives often leave struggling companies wealthy long before actual consequences fully arrive publicly afterward. That detail especially frustrates people because accountability appears strangely uneven during financial disasters repeatedly everywhere. Workers lose jobs immediately, while decision-makers sometimes receive bonuses during restructuring negotiations somehow afterward, publicly afterward. The optics look absurd because honestly, parts of the system actually are absurd underneath sometimes also. But complexity helps protect these arrangements, since complicated systems discourage public scrutiny and sustained attention naturally. Most people simply move on once markets stabilize and immediate panic finally disappears from headlines, until another crisis arrives, revealing similar patterns hidden beneath different corporate logos and industries again. That repetition matters because repeated rescues slowly redefine expectations about risk, responsibility, and economic fairness itself, RAB. And once expectations change permanently, reversing them becomes politically dangerous and financially destabilizing simultaneously afterward. Because markets now depend partly upon confidence governments will intervene during catastrophic moments quickly enough. Remove that expectation suddenly, and panic itself could trigger exactly what leaders feared originally beforehand. So the system becomes trapped between painful discipline and increasingly expensive long-term dependence economically nationwide afterward. Neither option feels particularly attractive once economies become deeply leveraged and politically interconnected everywhere globally. Which explains why failing companies rarely disappear completely despite obvious weaknesses visible for years publicly. Their survival no longer reflects pure market success, but broader systemic fears about collapse spreading elsewhere. And those fears quietly shape policies, prices, wages, and opportunities surrounding your everyday financial reality constantly. So when another struggling corporation receives rescue funding, remember the costs rarely vanish completely afterward anywhere. They simply move quietly through the system until eventually someone else unknowingly pays for stability